At the end of the day, everyone's goals are typically aligned in some capacity towards achieving some sort of time freedom. The reality is that life is expensive and there are still bills to pay. What they come to us for is figuring out a way to say, hey, here's what I've worked for previously in the past. Take this and help me avoid having to keep working going forward. And real estate is one of the best vehicles for that.
Hi, Tark.
Hey, morning, guys. How are you doing?
Good. Thanks so much for joining us this morning. So let me just give a little bit about Tark. Tark is a former BlackRock employee and current director of investor relations with Disrupt Equity. His focus is on capital raising for large multifamily acquisitions throughout the country. So welcome.
Thanks for having me, guys.
Hey, Tark. How you doing?
Awesome. Beautiful day here in Houston, Texas. Ready to make something happen. Help you guys.
It has been a nice day after several crummy days. With your background with BlackRock and your current project with Disrupt Equity, raising money for all kinds of just beautiful multifamily assets across the country. Definitely wanted to have you on for this show. So passive investing. So the question of the hour is, what are the benefits? And related to the conversations you're having with investors, so when you're having this conversation with investors, why they're interested in investing in some of the opportunities that you're presenting, what are the benefits that you're finding they're looking for in their passive investments?
Yeah, great question. So it's kind of interesting. I mean, I'll kind of relate this a little bit to my time over at BlackRock as well as time here, right? I think they're fairly similar in a lot of ways, but one of the big differences, of course, is that here at Disrupt Equity, we're working with a lot of individuals and entities, and let's just say, small to large entities and folks with their wealth. Whereas with BlackRock, they're looking at countries, right? Sovereign wealth funds. You're talking about trillions of dollars at a time. So it's similar kind of aspect, but different scales. But generally speaking, with what we're doing at the end of the day, the reason what we see all the time is that our investors, folks that want to work with us, they might be working a job or they might have their own company, right? But at the end of the day, everyone's goals are typically aligned in some capacity towards achieving some sort of time freedom, right? Not having to work all the time or give up their time for a job. Flexibility, let's call it. But the reality is that life is expensive and there are still bills to pay. So what they come to us for is figuring out a way to say, hey, here's what I've worked for previously in the past. Take this and help me avoid having to keep working going forward, right? Let's automate this process of bringing in capital and ultimately bringing in passive income, right? And real estate is one of the best vehicles for that. And obviously, I've come from the world of BlackRock and the financial markets and whatnot. And even from there, I still believe that real estate is easily one of the best asset classes to really invest in. And one of the realities is that in real estate with this passive investing, you get to basically move up a tier, right? Where instead of having to do the day-to-day operations of working a job, you basically have to give your capital and let someone else do that. Yes, There's always going to be someone putting in the work and the effort, but it doesn't have to be you, right? From your side of things, you should ideally level up, quote unquote, to do the diligence up front, determine, hey, is this a property that I am interested in? Is this a sponsor team that I do trust and I am willing to work with and give my capital to? And once you've done that and you feel comfortable with it, then you basically sit back and let the money come in, right? Obviously, let's take it back. The returns come in, and that could be either as cash flow or as capital appreciation over time. But the whole point is that you get to be a little more passive and let what they call true mailbox money be achieved. And really, real estate tends to be one of the best vehicles for that.
Yeah, I hear that all the time. It's they know they should invest in real estate, but they don't want to own. They don't want to deal with the Fridays and Saturday calls of plumbing issues, HVAC issues, because those issues only come up on Fridays and Saturdays. It's fact. But beyond that, you touched on a couple points that I want to dig a little bit deeper in. Cash flow versus appreciation. So it's wealth growth versus income. What are you seeing and how certain investors approach what their desires are? Is it mainly just a certain income level is more interested in one of those aspects, or a certain age demographic, or what are some of the questions that really come about when they're talking to you about an opportunity in relation to cash flow versus appreciation?
Yeah, good question. And the reality is there is no one size fits all answer. I think it really depends on several aspects, but what we kind of see is folks who are at different calibers of wealth will have different risk tolerances. And what you find is that folks who are extremely wealthy, who have had a lot of success, The reality is you only have to win the game of life one time, financially speaking. So folks who have won the game of life financially and they just want to maintain their wealth and not lose it, they're happy to take a lower return, right? They don't necessarily need the cash flow. They can live off of it. They're pretty comfortable, but they want to make sure that they can keep it growing and not have to lose it. Because at the end of the day, if you have, let's give an extreme example. If you have $100 million and you make another $1 million, that's great. But at the end of the day, is it really going to affect your life materially? The answer is probably no. So they are more interested in don't lose my money versus, hey, hit a home run and make me another 20%, right? Or 10%. They couldn't care less. They just want to make sure that it's preserved in their capital. Whereas folks who are a little younger in the game, or let's say earlier on in their career in the development, they like the idea of cash flow because they're trying to get the time freedom component. And right now they may be working 40, 80, 100 hours a week, depending on what, field they're in. They want to get to the point where they can sit back and say, all right, I don't have to dedicate that time. If I lost my job or if I wanted to go on vacation, I can do that without having to worry about it. So it really depends on kind of what age group you're in and what wealth class you're in as well. And then, of course, there's also the time component of, well, how old am I, right? Older folks, they tend to want to retire, and right, they're happy to keep that cash flow coming in because they don't have a source of income coming in from a day job. So they want the comfort of a consistent cash flow that comes in from their passive investments.
What type of in what ways are, because you're primarily in multifamily. I'm sure you did a lot more, different projects in BlackRock, completely different business. But with what you're doing now, what are a couple different ways, and this is an entire class in itself, but what are a couple different ways that investors can get involved on a passive level? Because I know there's preferred equity positions, and then there's the more common equity positions where they may wait a little bit longer for some upside. But what are a few different ways investors can get involved in passive multifamily?
Yeah, and you kind of alluded to it. There's a whole spectrum of it, right? There really is no end to this. Depending on how deep you want to carve this out, you could hit infinite numbers of options. But really, let's just focus on two main ones, right? There's kind of, you touched on this, preferred equity, which for those who don't know, it just means you're earlier on in the capital stack in terms of the priority. In the event of a bankruptcy or a failure of the property, who gets to get their money out first? And usually it's the bank is number one, and then preferred equity is number two, and then the last is going to be the let's just call them the shareholders, the common equity investors in a deal. So there's preferred equity, which is that priority position, and then there's common equity investors. So if you want safety, consistency, you're not really interested in hitting a huge home run, not to say that it's not significant. You can easily make 10% back a year pretty comfortably with preferred equity, then that is probably going to be the choice for you. But if you're somebody who you are more interested in compounding at a higher percentage points, but understanding that that's going to come with additional risk. And, as a side note, you can't get both. There's no way in any asset class that you can get the best return and the least risk, right? There's always some balancing act that goes on between the two. So if you're somebody who wants the safety of consistent cash flow without really much worry of losing capital, then preferred equity is where you want to spend your time in, versus if you want the higher returns, then you can go ahead and do the common equity. And that's what most people tend to do. But you kind of pick your poison, if you will. But to give some context, for our deals most recently, we have a handful of investors who want each type, right? But the way we kind of divide it lately has been roughly 20% of the capital raised on our deals are going to be preferred equity positions, right? They're going to take priority spots. And then the 80% are going to be in the common equity positions. So most people do tend to sway towards common equity, but you get a handful of folks who say, yeah, I don't really need that extra return. I just want the comfort of the safety.
Last 30 seconds. Is there anything like what should be maybe the top two questions those passive investors should ask someone presenting them with an opportunity, whether it's a sponsor or just anyone that's presenting them with an opportunity?
Yeah, I think this is a great question, but this is how I would maybe explain it, right? And I'm going to say this with my own biases of being a little more financially competent, if you will. And I think that passive investing is a great terminology, but it still requires you to do some sort of due diligence, right? Which is going to require some work. It's not just sit back on your hands and, life will figure itself out. It never works out that way. But what it's going to take is going to two things. Doing your due diligence on the sponsor team, right? Making sure that, hey, I trust that, because ultimately, no matter how good the numbers look, if you don't trust the person who's actually giving you those numbers, you should probably think twice of giving them your capital. And that's something to every single investor, because we've heard stories all the time, people who have been fleeced. And ultimately, that's why we're trying to elevate the entire industry and present people who are quality. And we know you, Chris, we've known you for years, and we know that you're in that category. But then the second question is going to be, show me the numbers, right? Show me your analysis. Don't just show me the output. Show me what were the underlying assumptions that went into it. Because if you come to a conclusion with your analysis, and it may look pretty, but if I don't agree with your assumptions going into it, then there's going to be a difference of opinion here, and I may not want to invest in you. Ultimately, I need to determine for myself, do I agree that your predictions for the future are in line with my predictions, or are they overly aggressive? Or maybe are they overly conservative, right? It could go either way, but ultimately we have to make sure that you have your perspective, I have my perspective, and we align on our perspectives. But once you have those two in place, then there's really no reason to move forward, to not move forward rather, and you can make things happen successfully.
Love it. Love it. Well, these things go quick. It's been a pleasure having you on, and I really enjoyed collaborating with Disrupt and everything you have going on over there. So look forward to seeing you again soon.
No, thanks for having me. Always a pleasure, Chris, and we'll be in touch for sure some more, and look forward to helping out your audience any more we can.